Welcome back to NextGen Investing. Now, stocks do remain near record highs despite sticky inflation, elevated treasury yields, and plenty of geopolitical uncertainty. So what is continuing to challenge and really support this rally? But joining us now to discuss that broader backdrop as well as the upcoming jobs report and where to find opportunities in today's market is Jeffrey Small, partner at the Retirement Income Source. And so, Jeffrey, thank you so much for joining us today. The market has powered through, though, a lot of these concerns like tariffs, geopolitical headlines, even higher rates. And so what gives you further confidence that perhaps this bull market has room to run still?
Well, AI capital spending is still incredibly strong and will be strong for the foreseeable 12 to 18 months. And that means earnings are going to grow. But valuations are stretched. And so earnings have been catching up slowly to valuations the last couple of quarters. And I expect that pace to continue. But we're approaching new highs here as we see some peace here. But there are risks going down the pike. And so, the market today is still climbing the wall of worry is the bottom line. But that wall is now built out of interest rates, oil prices, and overstretched valuations.
Jeffrey, I noticed in your notes you call the easy money phase over. So even if there's still areas of the market you like, does it change the approach, the sizing, the leash you give positions? What is the change in sort of the transition away from this, what you're calling easy money phase?
Well, I think I really favor companies that are connected more to long-term capital spending cycles, along with higher quality financial companies producing substantial cash flows. And so I think we've got to be extremely selective. The time for easy money is over, especially as a lot of companies are approaching these all-time highs. And so, you want to take advantage of the best companies and of the best financials, buy the dips, don't buy at these peaks right now, wait for volatility to add to your positions.
Okay, and so Friday's jobs report could also be a major catalyst. And so what would you consider the ideal outcome then for investors, and what would be your major concern?
Well, the good news is the Fed is not hawkish, the Fed is not dovish, the Fed is data-ish. And so I think Warsh has been tested now, and that's why we're going into this current market rally that we have. But a surprisingly strong jobs report could push treasury yields higher and put pressure on a lot of these growth-sensitive stocks. And so the best report would be to stay exactly where we are. Flat, benign, no increase in the jobs picture at all, no decrease in the jobs picture unemployment-wise. And so if we get a benign event, that would be the best thing for the markets at this time.
And in that context, assuming that's the case, sort of more of the same is in store for the next, foreseeable period of time, would you be using that opportunity to kind of, as you're saying, being selective with the portfolio, but maybe creating, maybe reducing positions elsewhere, creating that opportunity so that you have cash ready if you get that pullback? I guess I'm just wondering what we're doing to stay invested but remain selective at the same time, how we're actually achieving that.
Yeah, it's super intelligent to have, some dry powder on deck right now to apply to the dips. And we do that because we do anticipate rates to be a little bit higher, maybe going into the fall, even organically if the Fed doesn't do anything. We see the credit markets pushing up rates due to the inflationary aspect of what's occurring. And so, the Fed's not being restrictive, but let's say the marketplace is. And that ultimately could hurt the forward momentum of the market. And so if that does happen and we do have some dips, you definitely want to have some cash on the sidelines. But don't be fully invested at this time, and certainly don't buy at the peaks at this time. Wait for pullbacks.
Okay, and so your stock picks do span across things like AI, power infrastructure, and traditional banking. And so what is really this common thread that ties names like Nvidia, GE Vernova, and JPMorgan together in your portfolio today?
Well, the three picks that I have are not obviously to abandon technology. It is to broaden beyond technology a little bit. But I would combine Nvidia for computing, GE Vernova for power infrastructure behind AI, and JPMorgan for exposure to a higher rate economy, because rates are going to stay higher for longer, obviously, for many reasons. But you want to own the chip, own the electricity powering the chip, and own the bank financing it and the economy around it. That's how you broaden today.
That makes a ton of sense. It ties into what you said about focusing on the massive capital cycles, but also looking for cash flow positive businesses. Within a portfolio construction, looking for maybe things that are maybe inversely correlated or correlated differently or not correlated at all? Do you look beyond equities? Do you look to, things like precious metals or fixed income? Do you look to within equities, things like healthcare or energy to shore up the portfolio? Or do you really stick to those key themes that you talked about, capital cycle and cash flow positive?
Well, I think all of the above are applicable at this time. You're not going to be completely dedicated to one particular side of the equation, but having some fixed income and having some metals would be intelligent. How much metals? 3 to 5%. How much fixed income? Potentially 20 to 30%. Hold back 20, 25% in cash or more to take advantage of the environment that we have, because we are on, there are shifting sands in the markets affecting all three of those investing dynamics right now.
Okay, and so say being more selective here, what are specific characteristics that you find important when, say, assessing opportunities or assessing maybe a company going into its earnings?
Well, I think earnings growth is really, really important. Earnings guidance is more important at this time to give us, because we really have to perform better in guidance than what's expected or what the street's anticipating for share price appreciation go up or to catch up to current valuations. So that guidance is really the best marker to determine what positions you should have today in concert with what has been the growth quarter over quarter, year over year. But guidance is the perennial winner for what you should be buying today.
Okay, thank you so much. So appreciate your time today and great insight into some of the drivers of course, this back half of 2026. Jeffrey Small, partner at the Retirement Income Source.